so started doing all this self-education when my wife ultimately had to leave her teaching job for the time. And that ultimately led me to real estate as what I felt like was my highest and best use and best chance to make additional income on the side while also still being able to work my corporate job and build up that business. And so, through that, we started investing in single family like a lot of people do. And ultimately, when I realized and had some success and saw that it was working and that everything that I had learned could work, generate income, I wanted to scale it up. And so that ultimately led me to multifamily and to where we are now. And so we just kept going bigger and bigger, it seemed like, with each deal as the progression continued.
That was Kyle Jones. Stay tuned for this and much more. The limited partner shares in the potentially outsized returns of a well-planned and executed investment, but as a passive investor, and has the maximum leverage on their most precious asset, their time. And that is why we're here together. 90% of the millionaires out there built their net worth with real estate. However, 0% of the billionaires are hands-on managing their real estate assets because there simply isn't enough time. My name is Jake Wiley, and for the past 16 years, I've been investing in real estate, and I've learned a thing or two. But the most important lesson is how to leverage the expertise and time of others to maximize your investment potential. Welcome to the Limited Partner Podcast. All right, welcome partners. Again, I'm your host, Jake Wiley. This week, I'm joined by Kyle Jones. So Kyle is the president of TruePoint Capital, and you specialize in multifamily, right? But Kyle, welcome to the show.
That's right. Yeah. Thank you very much for having me, Jake.
Well, Kyle, I'm really excited to get into it. But for our listeners out there that haven't met you yet, I'd love to start the show with a little bit of background on who you are, how you got to investing in the multifamily segment.
Yeah. So, who I am as a person and as an individual, I'm first and foremost, I'm a follower of Jesus. Then I'm a husband, and then I'm a father. And then I'm a multifamily investor, if there's any other things in there that describe me. But, I think just to get right into it, I started looking to get into multifamily as a way to just generate some additional income for my family. We were in a position where it's a long story of this health journey that really incorporated my wife's health journey and her ultimately having to leave her teaching job for a time period about 10 years ago that launched me on this quest to generate additional income for our family. I had just started a new career. I was a software sales individual working for a large corporation at the time, but it was kind of an entry-level sales position. And so really wasn't making a whole lot of money initially going into it. And so started doing all this self-education when my wife ultimately had to leave her teaching job for the time. And that ultimately led me to real estate as what I felt like was my highest and best use and best chance to make additional income on the side while also still being able to work my corporate job and build up that business. And so, through that, we started investing in single family like a lot of people do. And ultimately, when I realized and had some success and saw that it was working and that everything that I had learned could work, generate income, I wanted to scale it up. And so that ultimately led me to multifamily and to where we are now. And so we just kept going bigger and bigger, it seemed like, with each deal as the progression continued.
Well, I think that's a really great story. I hate to hear that you had to go through some health issues to kind of get there. But I think that's the turning point for a lot of folks, right? Is that there's some fork in the road that really drives you towards, hey, look, we need to bring some more income. And I think that's also kind of the mission of this podcast, is to help people see that there is a way to generate income. And, you're active in it, obviously. And, the listener out there are looking for a way to potentially have the same benefits without having to go out there and figure out how to buy your own multifamily and run it and be the property manager and go get there. But I'd love maybe if we could dig in just a little bit more on how did you find real estate?
Well, I think I've always had an interest in real estate just in general. My dad was also a software sales account rep growing up, and he had always kind of talked about, hey, if he had to do it over again, he would have gotten more into real estate, or at least gotten more interested and started investing in real estate at a younger age. And in college, I spent countless times when I wasn't studying and playing baseball, I was watching Flip This House, which was a popular show back then. And I don't even know if it's still around, but I started watching it when it was one of the original, guys going through it, and just watching the creation process, I thought was just something that always stuck with me. One of the guys that it was the guy in San Antonio. I can't even think of his name right now, but he talked more about creating income versus just going out and finding a job. And so, I saw the power of real estate, going out and being able to actually create something. I think that's really telling in this day and age with the market that we're in. There's a lot of properties for sale out there, but not all of them are deals. And I think for me, a lot of the best deals that we have done are not necessarily the ones that look great on paper, but it's the ones that actually we're getting creative and we're having to think outside the box to generate additional income.
So was it Armando Montalongo?
Yeah. I figured you might think of it.
Yeah. I just remember he might have been the guy that started the whole concept of driving and talking into your cell phone as a way to communicate videos. I distinctly remember that. But yeah, that was a great show. I remember watching it too. But I guess thinking through maybe your transition, right? Because I totally agree with real estate. I believe it's the fastest and safest way to build wealth, right? Period. I've been at it myself for 15 years. But I guess your transition from doing, the smaller stuff up into multifamily. Tell us a little bit about that transition.
Yeah, what kind of started that was, at the time I was self-funding everything with all my single family homes. And so eventually, after a few of investments, we ran out of our capital that we had set aside to continue to invest. And so, trying to figure out a way to continue to do deals with not necessarily having my own money led me down this path of syndications and studying up on that, and realizing that what I know now is, you can actually build the same model with the single family, but that in combination with me also working towards very aggressively to replace my expenses with additional income. So I wanted to be able to generate enough income from my real estate investments to be enough to cover expenses. And then ultimately from there, once I hit that goal, then it became a goal to actually replace my income. And by this point, I was making better money and was more well into my career as a software sales professional, working for IBM at the time when I really started seeing my real estate investing grow exponentially. And so it was more the economies of scale that I felt that I was better protected with the risk of occupancy. If a tenant moves out with single family, it's like, hey, you're 100% vacant. And depending on the size of the property, if one tenant moved out of your multifamily property, you're more than likely on a larger multifamily still 98, 99% occupied, which is still very good. So you have all these other tenants that are still paying rent. And so you spread out your risk in that kind of scenario, while also for me, being able to work towards hitting some of those goals to replace my income.
Yeah, I think you really hit on a really key point too that I've run through personally myself, is that when you're in this single family or 4 units and below, right, is considered residential. And it's all you, right? If you're going to go invest, it's you've got to have the cash to come up with this thing. It's your credit, it's your guarantee, it's all of these things. And you just reach a point where you can't do anymore. And I was actually writing a little article on LinkedIn today about this, of you just hit this limit where it's you almost have to just wait. It's a function of I've hit the limit. Now I've got to wait for the market or these improvements or the rents to go up so I can then turn around and do it again and refinance. And it becomes very tedious. Is that similar in your experience when you kind of transition into the larger stuff, being able to just do more?
Yeah, exactly. And for me, a lot of the projects that we were buying on the single family needed some form of work. And so having the contractor spread out, and I live in Houston's a big city, and not all these homes were right in the same neighborhood. And so I was using the same contractor, but it was still difficult for him to gain economies of scale with these projects because it wasn't like they were right next to each other. So, even from that perspective as well, when you come in and you're renovating units, you can move through that pretty quickly. A contractor that is well experienced can handle that and work efficiently with turning over units and making renovations, flooring, paint, all that, and can generally knock it out really quickly because, he's not having to get in a car and go. And the only time he's doing that is maybe to go get more paint or whatever. So, that's what we experienced.
And I guess in terms of where are you investing? Are you really focused in the Texas market, or are you kind of looking all over? What's your geography?
Yeah, right now we started in primarily all over the Southeast. And right now we're pretty fixated in Texas. So Houston, San Antonio, Austin areas. And then we also invest pretty heavily in the northern Alabama area.
Okay. Well, I'm going to change gears a little bit here and really kind of focus in on limited partners. So you're bringing investors into your deals now. I guess as you think about the value that you're able to bring to them, how do you explain it? What does a limited partner get by investing in a multifamily deal with you guys?
Yeah, I think first and foremost, one of the things that we always talk about is this is no longer an exclusivity type of offering. There's lots of people out there that are able to do this, which can be good and bad. I think it's good because the limited partners have a plethora of deals to kind of compare them to if they're working with multiple operators, if you will. On the negative side, there's a lot of people doing it that probably don't really know what they're doing. And I'll be the first to admit, I don't know everything. But one of the things that I think has really contributed to my personal success in this space is surrounding myself with a very strong team, a very strong team of professionals. Especially like right now, we're pretty heavily focused on developing. And, we're developing 250, 350 unit size properties. And me personally, not having any experience in that, knew that I needed to go find a partner that did, which led me to a guy that had been working for a REIT, developing for this REIT for 20 plus years, engineer background and all that. So he really knew how to put all the right people in place and take that approach. And so, that's how I kind of caution people from a limited partner standpoint looking into this, because the access is there. They really have to come in and they actually do have to educate themselves a little bit. It's not as much as somebody would need to on the operator side, but they need to be able to understand some of the mechanics of what makes a good deal. And okay, I see if somebody's forecasting increasing rents, what does that percentage look like? And how long is it going to take to increase rents? And so there's like little things like that they should be able to vet and understand. I mean, in this market, if somebody is being very aggressive for their underwriting and their pro forma, they should know that. They should be able to spot that. And they should also be able to spot, if it's a good market, if it's a good actual location within that market. And so there's just some high level things that I think the average person who, even though they're passive and they don't have all the education, there's some things that they can look for that I think would really help them just being a little bit educated.
This last point I thought was really great is that if you look at several deals, you should be able to understand if somebody's being really aggressive, right? Because I think that what I've learned over the course of my journey through this is that, there's some little numbers in these pro formas that can make a really big difference. Rent increases have a really big impact on the net OI, the net operating income, which drops to the bottom line. And if you're talking about cap rates near 3%, like the multiplication factor there is it's magnified significantly. But doing diligence on some of these deals, like it really helps, I guess, being able to see where people might be really aggressive, because sometimes you have to be really aggressive in this current market in terms of the way you present your numbers for them to pencil. So if somebody came to you and said, hey, look, I'm looking at some deals and I'm not really sure, like, if they're being overly aggressive, what are some big red flags that you would caution somebody to look for or make sure that they're looking at?
Yeah, I think since we're talking about rent increases, I would start with there. I mean, and it's really in no particular order. I think these are probably just 3 or 4 things that I could look at pretty quickly and tell if somebody's being aggressive. And all of them are important. So starting with rent increases, what does that look? And it has a lot to do with the type of property it is and obviously the location. And you can go out to like things like apartments.com, and you as a limited partner can look at some neighboring properties and just kind of see, hey, what's this neighboring property advertising? Are we pricing ourselves out of the market, or are they truly getting, $200 and $300 rent bumps? Because if somebody is forecasting $200 and $300 rent bumps, in year one, that's pretty aggressive to me, especially when you're looking at an average, because when you go in and you buy, larger multifamily. So what I consider larger is probably, I think by definition, anything over 50 units, but I think of it even a little bit larger than that. Maybe let's focus on the 100 unit range, because that's primarily what I see. Anywhere from 100 to 350 units is average property size in the markets that we're in. So, if somebody's coming in and forecasting, even on a 100 unit property, that, hey, they're going to see $200 rent bumps on average. And if they have that in their model as that they're going to achieve that in the first year, that ain't happening. You're not going to turn over 100 leases for $200 in rent bumps in year one. I'm not saying it's not going to happen over time, but what I'm saying is it is very aggressive to automatically assume that you're going to increase rents across the board in the first year. Just even in the first 3 months, could even be 6 months, depending on the property, you're just still going to be transitioning the property and getting familiar with the market. And so you don't have 100% turnover, and you're not necessarily going to gouge somebody who wants to renew. You're going to increase their rents on renewal, but you're not going to increase it up by, $200 and $300. I mean, depending on the market, right? So that's a big red flag for me, is how aggressive are they being in the first year with rent bumps. The other one, you mentioned cap rate. And so I think if they are forecasting that cap rates are not going to move, or they're going to stay the same, or they're actually going to lower over the course of the next 5 years, 6 years, especially with the rising interest rates, that's a little bit reckless to me. Whoever is in this space needs to be forecasting at least a little bit higher cap rate than what they're buying at today, just based on the common sense of rising interest rates alone. And you can actually influence the numbers and the returns quite a bit by just changing the cap rate number from where your exit is. And so, you don't even have to add any kind of rent bumps in that case to make it look like a great deal. And so that's a little scary.
And that's one, right, where we're talking about a change in like a fraction of a percentage.
Absolutely.
Right. We're saying, hey, the cap rates are now 3.5%, and we're saying, oh, it's going to go to 3.25. That's such a small number that, like, if you're looking at somebody's deck, you're like, oh, okay, that doesn't seem unreasonable. That has a massive impact, especially the lower you go. Like, it's really important. So I'm glad you called that out. Thank you.
I think that's key. And then the other big one for me that we're seeing is rising costs of taxes and insurance. So everywhere, every county across the nation is seeing an increase in taxes. And then every market that I'm aware of, it has seen an increased cost of insurance. And so if those are flat across the underwriting, and usually most people have line items that they should be willing to share with you on what they're forecasting, or if not, you can just ask them. But there has to be an increase in taxes and insurance over time. And we learned the hard way, honestly, with a couple of our deals that we bought, 4 and 5 years ago, and we didn't forecast the insurance. I don't think anybody really could have forecasted how aggressive insurance has gone up across the board. But, in some of our markets, we saw, 2.5 times increase just in 3 and 4 years. So that's how aggressive it is right now. And I honestly don't see that slowing down from what I'm hearing with just the cost of doing business these days, and inflation, and then the amount of claims that are out there. So those are kind of the 3 key items that I would look at. I could probably, take up another 30 minutes of your show and go through it, but those are like the high points that I think are pretty easy for most people to get educated on and kind of vet as they're looking at other deals.
Yeah. I mean, it's a great point, right? Because if you're looking at a deal, I think that you can go into like heavy diligence mode and get completely overwhelmed and like wear yourself out. But if you have a couple of things, like just some basic assumptions that you can go and look and be like, does this make sense to me? Like, what are they doing with cap rates? What are they doing with rent increases? What are they looking at with like just basic, taxes and insurance costs you can't avoid? What do they look like? And if you get a funky feeling about any and all of those, if you get all of them, you probably should just keep looking, right? But if you get a feeling like these are the questions that you should be asking, right? And I think that's great. And you can start, because like when you're investing with somebody, it's a long horizon, right? And you get to where the end of where you thought it was going to be. And what if we're in a weird market cycle? And like the best thing to do is just to kind of refinance or move through it and keep going. You need to know how the investors you're working with are thinking, right? Is that fair?
Yeah, absolutely. Which that brings up another point with how they're structuring their debt. And, how are they building in contingencies to be able to do that and withstand that type of environment, especially in today's market? Are there extensions in place? A lot of people are only able to do any deals in this market because of the bridge market, which, a lot of people are starting to pull back as well. And some of the debt funds aren't being as aggressive as they were in 2021. Now, there's still some small guys popping up now. We're seeing a lot of that, but we're also seeing a lot of people kind of pull back because of a lot of it had to do with just the interest rate environment. In terms of actual length of terms for the debt, that's where that will really come in. And you want to make sure, hey, if we do have to hold on to this thing, which has shaped my investing perspective right now, I want to make sure that I'm investing in a property that's in a good location that I could feel safe going to, and that it's in a really well located area. And that number two, on the debt side, that, hey, if I had to hold this thing for 10, 15 years, could we, and would we want to? Which has pushed me more into the development again, because a lot of these buildings, I've seen it, they take a lot of time and money to continue and maintain these properties that were built in the 60s, 70s, and 80s. Even if they're located well, they're still taking up quite a bit of capital to just maintain, because it's just an older building, older structure.
On that age thing, I think that's a really great point, because you think about, like, when you look into a market, one, you want to know what market you're comfortable investing in, right? Or is there net population growth? Is there like not concentration on specific employers? Like if they put this one employer pulls out, like the whole thing could go kaput. But then,
Yeah.
Age of units, right? Like there's a lot of older stuff that are in great locations now. Maybe when they were originally built, they're kind of on the outskirts, but now they're like in the heart of things. But functional obsolescence of a unit, like people just don't want to live in that anymore. 7.5-foot ceilings, 800
Yes.
square feet, like one bathroom. There's a lot of that out there, and it exists. So, I mean, there's a risk in the building itself. It's not just like, is this what we're going to do? But like most of what we're looking at, and correct me if you see this differently, but there's a value add component, right? I'm going to buy it for the market rate today, knowing that I can turn around and do some things to raise rents, maybe reduce costs, but like maybe reducing cost is out of the window for the foreseeable future. But like that's the value add. That's where you really bring, the returns. It's kind of like flipping a house, like you're flipping an entire apartment complex building. But I guess the other thing you brought up too, which I thought is, what are the assumptions in year one? Year one is just a transition, right? Like you got new management, you're making renovations, you're probably scaring people off, right? That have lived there and lived in quasi rent control. And like, yes, it's good to turn it, but like you might be doing a lot more renovations in the first year than you thought, right? But, I'd love to like kind of get your thoughts on some of those things.
Yeah, for me, everything's pretty flat in terms of expenses and rent growth. So we really don't start forecasting any amount of rent growth until year two. We generally, to be conservative, we do forecast taxes to increase. I mean, going in, we know where our insurance is. So insurance year one, we're not taking what the current owner, we're just going based off of our current quote and then increasing it from there year over year. But the biggest assumption that I think that gets left off is that people don't realize, for exactly what you were just talking about, you're going to experience some vacancy. Every transition we've gone through, we have always experienced vacancy, whether that lasts for 1 or 2 months. We're experiencing it, and it's now been 7 months since we bought it, and we're still climbing out of the hole from just the mass exodus that we saw in the first 2 months of ownership. And so, you just want to make sure that somebody or whoever the operator is, that they're looking at it with that same lens, because, that's conservative. Because again, if nothing happens, then great, even better. Now you're going to make more money on that type of deal. But those are, the couple things to call out. But the main thing is at a minimum, keeping everything flat.
Yeah, great point. Well, I know we're running up, here on time, getting ready to close. Is there anything else that you think is worth sharing that would help make this episode complete?
I would just reiterate, even though it's a passive limited role, it's not like you don't want to just sit back and don't do any homework. There's some things, you don't have to be an expert, but like we talked about a few of those on this episode. And then even just educating yourself on specific markets, which there's just so much information out there right now that, I mean, most people should know that it's a good market. But I will say not all submarkets in Dallas, Texas are growing and booming in places that you want to live and invest in. And that's the biggest key, that we drill another couple layers deep inside of, oh, this deal's in Dallas. I know Dallas is booming, or Austin, like all these notable cities that are growing. Yes, they are, but not every submarket is growing. And so passive investors need to understand that.
Well, Kyle, I like to end every episode with like just an opportunity to give somebody a shout out, a little bit of gratitude, because, along the way, somebody's giving you a leg up that you probably didn't deserve. And I want to give you an opportunity in the public forum to maybe give somebody a shout out and say thank you.
Man, there's a lot of people to thank. I think the first person that comes to mind is my wife. She's stuck by me through all of my, mad scientist type of ideas. And most of them have paid off, I'll say. So she's the one that I owe my biggest thanks to. But, in that same light, I'm always here. I make myself pretty available to people who want to reach out or just want to jump on a call. Happy to always do that. And so people can reach out to me. I'm pretty easy to find on social media, LinkedIn, Facebook, all of those. So anybody that hears this and wants to have a call and talk further, I'm happy to do that.
Well, I love it. I totally agree with you about the wife being very supportive. It makes a really big difference when, you take some leaps of faith and somebody standing behind you saying like, I actually really believe in you. But Kyle, This has been a great show. Thank you so much for being on.
Thanks, Jake. Thanks for having me. Had a lot of fun.
I hope you've enjoyed today's episode, and I'd actually love for you to contribute to a future episode. If you have a question you'd like answered, or a topic or a guest to bring on the show, please email me at jake@thelimitedpartner.com. Now, I realize there's a lot of lingo that's thrown around on these shows, so I've created a cheat sheet for you with the top 26 terms that come up most often. Head on over to thelimitedpartner.com/lingo for the list. Enjoy, and we'll see you next time.